based on personal, real, and nominal account, the three golden rules of accounting are formed. Now, if you are not familiar with what exactly is personal, real, and nominal account, we have explained these terms in our earlier videos. The link to the videos will be mentioned in the description box below. Kindly check once before proceeding further. Okay, so let's continue. These golden rules of accounting form a traditional approach for recording the effects of debit and credits on accounts. These rules help us in journalizing accounting entries. First rule is for personal account. Debit, the receiver, and credit, the giver, wherein the person who is receiving something from the business is called as the receiver. His account is to be debited. Similarly, if a person gives something to a business, he is referred as giver and his account is to be credited. For example, goods worth rupees 200 sold to Neha. In this transaction, Neha, being a person, is the receiver of goods. And as the rule says, her account, that is receiver's account, will be debited. Now let's see the second rule, that is for real account. Debit what comes in and credit what goes out. Here, if any asset or goods come into the business, then the account of that asset or good will be debited. Similarly, if asset or good goes out, then the account should be credited. For example, goods worth rupees 200 sold for cash. In this transaction, goods are sold out and are going out. Therefore, they will be credited and cash is coming in. Hence, it will be debited. Third rule is for nominal account. Debit or expenses and losses and credit all incomes and gains. If a business incurs expenses and losses, then expenses account will be debited, and if it incurs income, then income account would be credited. For example, paid rupees 100 for commission to agent. In this transaction, commission paid being an expense will be debited in the books of accounts as per the rule. Now let's see a few transactions on how to implement the golden rules of accounting. Here are a few examples. Okay, so the first transaction is purchased goods worth rupees 50,000. Now, in this particular transaction, there are two things or two accounts that are being noticed. First, goods are being purchased. So one is goods account. Okay. The second thing that they are purchased for rupees 50,000 in cash. So the second account that is being noticed here is the cash account. So the two aspects that can be affected will be goods and cash. For goods account, because goods are coming in the business, and cash because cash is going out of the business. Now, let's see the type of account. Now, these two things which are affected, okay, are both real account. Why? Because real account means or includes all tangible and intangible assets. Therefore, goods and cash both are tangible assets. Therefore, they are a part of real account. Now, let's see the rule. So, the rule for real account is debit what comes in and credit what goes out. Now, clearly, in this particular transactions, goods are coming in and cash is going out because we have purchased goods that are coming in the business, and cash is going out because that is what we have paid for these goods. So what comes in is debited, thus goods are coming in, so goods account will be debited. Similarly, for purchasing these goods, we are paying 50,000 as cash, therefore cash is what goes out, therefore cash account will be credited. Now let's take another transaction. Deposited 10,000 in bank. Now two accounts that I can see here which can be affected clearly is one, bank account. Okay. The second account is cash because you're depositing cash in bank. So second account is cash account. Now bank account is a personal account. Why personal account? Because in our earlier videos also we have mentioned that bank is an individual recognized in the eyes of law. Therefore, bank is a person and formed and comes under personal account. Okay, so now let's see the rule for bank, or let's see the rule for personal account basically. So the rule for personal account is debit the receiver and credit the giver. Okay, so what is bank account doing in this transaction? Is it a receiver or giver? Now when 10,000 rupees will be deposited into the bank, of course bank is receiving 10,000 rupees. Hence it will be debited as debit the receiver. Therefore bank account will be debited in this transaction. Now cash is going out. The second account, cash, which is affected, is going out. Now cash is a real account as we discussed in the earlier transaction. Okay, cash is a real account because it is a tangible asset. Now, according to the rule of real account, debit what comes in and credit what goes out. Similarly, in this particular transaction, cash is going in or coming out. We have deposited 10,000 in bank. So from business account, the cash is going to bank. So the cash is going out. Therefore, it will be credited as we have to credit what goes out. Therefore, cash account will be credited in the books of accounts. Okay, let's see the next transaction. Paid brokerage 1,500. Now, here again two accounts are being noticed. Okay, 1,500 straight away is a cash account. Okay, then paid brokerage. Okay, so brokerage account. Okay, now brokerage is an expense. Therefore, it is a nominal account. It comes under nominal account. So what is the rule of nominal account? The rule of nominal account is debit all expenses and losses, credit all incomes and gains. Therefore, in this particular transaction, brokerage being an expense will be debited as per the rule of nominal account. So brokerage account will be debited in books of accounts. Similarly, cash is a real account as discussed earlier. Now, as per the rule, credit what goes out and debit what comes in for real account. Over here, cash is going out because we are making a payment to someone. Okay, so therefore, credit what goes out, this rule will apply. Therefore, cash account will be credited. Okay, so this is how we are supposed to sort out a transaction. Let's see fourth transaction. Bought cash 30,000 in business. Now the two accounts affected here are cash. Now you can easily find out cash here, the name cash. So one is the cash account that is affected. So first account affected is cash account. Of course, cash is a real account. Okay. Next, what is the second account that will be affected? Bought cash. Okay, 30,000 in business. So over here it is very clear that the proprietor or the business owner is bringing this cash in a business. Okay, so any money or any asset bought in by the proprietor into the business is nothing but capital. Okay, capital is again a personal account because it comes under definition of personal account. Okay, next. Now, cash is a real account and cash is coming in the business. Cash is coming in the business. Therefore, as per the rule of account, debit is what comes in. So cash is a debit because it is coming in. So cash account will be debited. Now, the next is capital. Capital is a personal account, and the rule for personal account is debit the receiver and credit the giver. Over here, the proprietor is giving the capital to the business. Therefore, capital will be credited into books of accounts. Okay, let's see this last transaction. Sold furniture worth 5,000 for 3,000. So, a furniture worth rupees 5,000 is being sold for 3,000. Now, in this particular case, there are more than two accounts that are being noticed. Two accounts which are noticed straight away are cash. There is a dealing in cash going on. Sold a furniture worth 5,000 for 3,000. So let's forget about this first. Let's not consider 5,000 here. Let's read it like this. Sold furniture for 3,000. Now, in this particular statement, when we eliminate this worth 5,000 part, the sentence is sold furniture for 3,000. Now, in this particular sentence, I can see two account. Okay, first account is 3,000 and second account is furniture. Okay, now 3,000 is nothing but cash. Okay, so that is a real account. Okay, next, furniture. Furniture is again a real account because it is a tangible asset as discussed earlier, right? So two accounts are being done. What to do of this third account, the one which we eliminated worth 5,000? So what they are saying is that a particular furniture was of 5,000, but now we are selling it for 3,000. So clearly there is a loss of 2,000 here, correct? So now this loss of 2,000 is nothing but a nominal account. Okay, and this account is profit and loss account, which is a nominal account. Okay, preferably it's loss, but you cannot write loss account, so it will come under the heading profit and loss account. Okay, next. So now the three accounts that are affected are cash, profit and loss, and furniture account. Both cash and furniture are real account, so rule of real account will be applied, and profit and loss, basically a loss is a nominal account, so rule of nominal account will be applicable. Okay, now let's see for cash in real account whether cash is coming in or going out. Okay, so sold furniture, when it is sale, it is obvious that cash is going to come in. So cash will be coming in. So debit what comes in cash account will be debited. Okay, see, cash is coming in business. Next, for profit and loss account, for profit and loss account, debit all expenses and losses. Nominal account rule will be debit all expenses and losses, credit all incomes and gains. So now here it is a loss. It is a loss of 2,000. Therefore, it will be debited. So profit and loss account will be debited. Similarly, for furniture, furniture being real account, whether it's going in or coming out. Now, sold furniture, that means we are selling off the furniture. Furniture is clearly going out from the business, and hence, as per the rule of real account, credit what goes out, furniture will be credited. If you really liked this video, please subscribe our channel and also hit the like button. Thank you.